All right, let's kick things off with a real head scratcher. On the very first trading day of 2026, something strange happened. Energy stocks absolutely took off, soaring higher. But the thing they sell, oil, well, that actually went down. So what in the world is going on? Let's dive in and unpack this paradox. So picture this. It's January 3rd, 2026. The opening bell rings for the first time this year. And right out of the gate, the energy sector is acting, well, weird. It's like the parts are moving in a completely different direction from the whole. And this is the central mystery we're solving today. I mean, how can the shares of companies that literally pull oil out of the ground be going up when the value of that oil is going down? It feels like it defies all logic, right? But the answer tells us a whole lot about where the market might be heading. And look, we're not talking about tiny little bumps here. The numbers show this was a serious rally. You had the oil field services giant SLB jumping almost 5%. And big ETFs like OIH and XOP saw really solid gains. Even the titans, Chevron and Exxon, were comfortably in the green. It was, by all accounts, a fantastic day to be an energy investor. But then you see this. On that exact same day, the price for crude oil, both the US and the global benchmarks, actually dipped. Now, sure, the drops are tiny, but that's what's so interesting. The direction is the complete opposite of what you'd expect. This right here, this is the paradox in a nutshell. Okay, so to crack this case, we have to zoom out a little bit. We need to look beyond just the oil fields and see what's happening in the wider market. The first clue isn't really about oil at all. It's about where big money is deciding to go. There's this big trend kicking off the year called sector rotation. Basically, after a year where giant tech stocks were all the rage, we're seeing investors cash out some of those profits and move their money into what's called the real economy. We're talking about sectors like manufacturing, industrials, and yep, you guessed it, energy. So a big reason energy stocks are up has nothing to do with barrels of oil and everything to do with this broader market shuffle. But hey, that's only part of the story. The price of oil itself is caught in this massive tug of war between two really powerful opposing forces. And if you can understand this dynamic, you can understand the entire energy market right now. It really boils down to this. On one side of the rope, you've got the push factor. This is all about near-term fears, geopolitical chaos, things that could disrupt the supply and push prices higher. But yanking on the other side of the rope is the pull factor. And that's the long-term forecast that says there's going to be a global glut of oil, which would pull prices down. These two forces are just battling it out. So let's dig into those geopolitical push factors for a second. There are two major wildcards on the world stage right now that have traders feeling pretty antsy and are creating a whole lot of uncertainty. First up, we have OPEC+. Now, for anyone who might not know, just think of them as the super group of oil-producing nations, including Russia. They all get together and decide how much oil to pump, and their decisions can and often do completely change the game for global prices. And boy, their influence is top of mind for everyone right now. As analyst June Go put it, their decisions this year are going to be critical for balancing supply. In fact, they have a huge meeting coming up on January 4th, and the entire market is basically holding its breath, waiting to see if they're going to cut production to stop prices from sliding. Okay, the second big geopolitical wildcard is everything that's happening in Venezuela. Things over there are developing super fast, and any hiccup in their oil production could send ripples through the entire global market almost instantly. And the situation is, to be honest, incredibly murky. On one hand, you've got President Trump saying U.S. companies are ready to jump in. Then you have Chevron playing it very cool, just saying they're focused on safety and following the rules. And at the same time, Venezuela's own state-run oil company is insisting that everything's fine, no damage, business as usual. The bottom line is, nobody really knows for sure what's going to happen next. So with all this push and pull, this chaos, what should we actually be watching to see which side might win this tug of war? Let's get into the hard data and the key dates you need to know. First, let's look at the supply coming out of the U.S. The government's own energy forecasting agency, the EIA, is predicting that America will produce an average of 13.5 million barrels of crude oil every single day in 2026. That is a staggering amount of oil. And it's the very heart of that long-term pull factor we talked about, a potential massive oversupply. And all that extra supply, it has a direct effect on price forecasts. That same agency, the EIA, thinks the average price for U.S. crude will be just $51 a barrel in 2026. Remember, it's trading over $57 right now. So the official U.S. forecast is basically saying prices are more likely to fall than rise this year. Of course, the government isn't the only one with a crystal ball. If we look at what other analysts are predicting for Brent crude, you see a bit of a range. The EIA is on the low end, around $55. DBS Bank is a little more bullish, seeing it somewhere between 60 and 65. And then you have Priyanka Sachdeva from Philip Nova, who basically sums up our entire explainer here by pointing to that core tension, geopolitics versus oversupply, as the one thing to watch. So if you're watching this space, here are the dates to circle in your calendar. January 4th, we have that crucial OPEC Plus meeting. Then the corporate news starts rolling in. We get a filing from Exxon on the 7th. And then later in the month and into February, we have earnings calls from SLB and ConocoPhillips. What these big players say about their future plans, that's going to send huge signals to the market. And that brings us right back to our final question. We have this epic showdown. The short-term chaos of geopolitics pushing prices up versus the long-term reality of a massive global supply pulling them down. So which one of these powerful forces do you think is going to win out and really define the story of energy in 2026?